Bonuses on Wall Street expected to hit all-time highs. You can see the sort of whipsaw this morning this year as employees across the country have struggled to get some equitable pay to their workers during the current hiring crisis. Joining us right now is Lydia Moynihan, a Wall Street reporter at the New York Post. Also, Kate Kelly is with us, New York Times reporter and CNBC contributor. Good morning to both of you. We are grappling with this new news this morning, which I don't know if that's going to impact bonuses or not. I think this year they might have gotten through. It might impact next year. We'll see. But what are we expecting to see both on the very, very high end? But what I think the big distinction this year is actually going to be on the first and second year associates. Right, Lydia?
Yeah, Wall Street is expected to dole out record bonuses this year. We're talking 30 to 35% higher for investment bankers. That's ranging from the junior bankers all the way up to senior managing directors who are really rainmakers for the firm. And fundamentally what this is a supply and a demand issue. So when it comes to demand, this is a hot year for banks. They're inundated with business. There's an influx of SPACs, IPOs, mergers, and work they need to get done. Major banks like JP Morgan are actually having to turn away business and substantial revenues because they don't have the horsepower to get it done. And when it comes to supply, there's a couple things that are happening. So the first is it's a hot labor market and bankers are mercenaries. They're going to go where they can get the most money. And boutique firms like Centerview, Evercore are willing to pay through the nose for these people. And you touched on this, Andrew. The pool of people interested in this kind of work is diminishing, particularly at the analyst and associate level. You have younger bankers kind of picking their heads up, looking around and saying, I could get a job in big tech. I can go work at Google. It's better hours, good pay. There is kombucha on tap. There are nap pods. That's not what life is like at Goldman Sachs. And banks, of course, recognize this and are looking to compensate accordingly.
Kate Kelly, kombucha, it might be the way. What I was going to ask you relates to actually the comp ratio. For so many years, you'd get the earnings report from one of the big banks, and you'd look at what the comp ratio was, and that was actually a big factor in the way a lot of people thought that. And Goldman obviously had a higher ratio than some of the other banks. Then all those ratios started to come down. Are they really about to move up, or is it just that much more profitable business right now?
Well, it's hard to know because this year is so exceptional, especially relative to last year. I mean, I think we very well might see that happen, Andrew. And again, as you said, the market changes day to day, including today. So stay tuned. But I thought it was interesting at Goldman. Lydia mentioned them too. They gave one-off compensation to their top two people, David Solomon and President John Waldron, in stock-based compensation worth tens of millions of dollars. This is on top of their base salaries and their compensation for last year and the coming year that's tied to performance targets and also 5 years of additional tenure with the firm. But that tells you that both at the entry level, which we were just talking about, and at the very senior level, there are retention concerns because it is such a hot market and these are such marketable skills. The things you learn as a young investment banker are translatable to lots of other careers, including in private equity, where at the mega firms, Johnson and Associates predicts that you're going to see 15 to 20% bonus upticks year over year, and in asset management and other fields. So I think a lot is changing this year. Whether it sticks, though, is the bigger question.